Welcome back to the Retirement Fiduciary Podcast, a place where we have authentic, no BS discussions about retirement planning, investment strategies, and wealth management. Whether you're approaching retirement or if you've already made work optional, this show is for you. Now, here's your host, Adam Koos, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group at libertaswealth.com.
All right, everybody. I hope everybody's having a good week. And if you're watching this in the weekend, I hope you're having a good weekend. If you live in the Northeast, hopefully you're staying warm. Went from a really nice fall to winter really fast around here. But I'm Adam Koos, President and Portfolio Manager at Libertas Wealth Management Group in Columbus, Ohio. And this is the second installment of NERD-vember, as I like to call it. Every single year in November, we like to do our podcasts, our screencasts, for our articles to all be a little bit more nerdy. And so, while I would say a minority of our clients, I don't have a percentage. If I were to make one up, maybe 10 to 15% of our clients really, really dig this more technical stuff and like to learn a little bit more about how we manage portfolios here, the kind of things we're looking at on a day-to-day basis. So every November, we call it NERD-vember, and we nerd out and we go over a bunch of technical things. On the last episode, if you missed it, go back 2 weeks, technically the most recent episode, the podcast, the Retirement Fiduciary podcast, we talked about price and trend. And today, I was just going to talk about momentum and volume, because price, trend, momentum, and volume are kind of the three or four biggest things or main things that I watch on a day-to-day basis. But I also look at things like breadth indicators. I also look at other weights of the evidence or pieces of weight of the evidence, such as relative strength. So I don't want to get too much into breadth today. I think that's probably another discussion for another day. I don't want to cram too much into this thing. But today I'm going to talk about momentum. We're going to talk about volume. And then I'm going to throw in a little bit about relative strength as well. So we're going to bounce around a little bit. But as usual, when we talk about charts and when we're looking at a lot of visuals, for those of you who are listening on Spotify or Apple Podcasts, I'll do my best to talk you through it here. But it's probably best to watch this episode at some point as opposed to listening to it. Just because we are going to be very content heavy on the visuals. So with that being said, let's go ahead and jump into it. So last time we talked about trend. I personally don't like drawing, diagonal trend lines on charts like this. Here's a trend line. We can say, it's in an uptrend right now. And then, it's not in an uptrend anymore. And then you can change your mind and say, it's still in an uptrend. Look, we have this new trend here. And now that's the uptrend. And somebody who's more short-term might say, well, no, that's not the uptrend. This is the uptrend. We are drawing lines at the bottoms here and saying that's the new uptrend. But in my opinion, when you look at trend lines, diagonal trend lines, manually drawn trend lines, I don't think they're reliable. I think they're way too subjective and it doesn't make any sense to use them. So we talked about trend last time. We talked about using moving averages. We didn't talk about horizontal lines of support and resistance. We're not going to talk about that today. But I do want to talk about momentum. And one of the main momentum indicators I use is something called RSI. It's Relative Strength Index. And in the bottom here, Relative Strength Index is an indicator that basically goes from 0 to 100. When it's above 70 or when it crosses above 70, it is said that whatever the investment is in the upper pane here is in a bullish regime. So in other words, it's in a bullish camp, or it is a bullish stock from a momentum standpoint, or it doesn't have to be a stock. It could be a bond. It could be a bond ETF. It could be a stock ETF, industry group ETF. It doesn't make a difference. So whenever it crosses above 70 and then back below, it doesn't really make a difference. As long as it's crossed above 70 in the most recent cross has been above 70, then it's considered to be bullish from a momentum standpoint. Second of all, when it crosses below 30, which is where I have the other line drawn here, crosses below 30 at any point is said to now be in a bearish regime, which is obviously the opposite. If you missed last episode, again, the reason they call them bears and bulls, bear markets and bull markets, is because bulls attack with their horns from the bottom up and bears attack with their hands, or the claws, I should say, from the top down. So if this crosses above here, like you see, this is the S&P 500, it crossed above 70 a couple different times here. And since then, even during the most recent 10% drop in the market this summer, between July and August, just a few weeks, it still wouldn't cross below 30. So it still stayed in this bullish regime. So that's the first thing that we look at, is whether or not it's bullish or bearish. We want it to stay above 30 and cross above 70 from time to time. And that means that the coast is clear from a momentum standpoint anyway. However, there are other ways to look at this too. The second way to look at it is in what's called divergences. So if you connect the tops here, if I go from here to the top, I've got rising highs, right? What we want to see in a bull market from a price and trend standpoint is we want to see higher highs and higher lows. But what we don't want to see in a momentum is what we're seeing right now, which is lower highs and lower lows. And technically it's not, we've got higher highs and higher lows here in short term. So you could say, well, hold on, Adam, there's actually higher highs and higher lows here recently, since August, since this most recent correction. And that would be true. But over the long term, I'm seeing the market head higher and print higher highs, but I'm seeing a lower high most recently in momentum, first and foremost, while the market's been hitting a higher high, or really an all-time high. So we're seeing a lower major high in momentum, first and foremost, but second of all, and almost equally important, is that most recent high is actually below 70, which is not good. So when you start to see things like this, where you're getting lower major highs in momentum, especially when the lower major high is below 70, that's significant. And when you have higher highs, and especially all-time highs in the market, and what we call that is a negative momentum divergence. So we've got a divergence to the downside here, and it doesn't mean the market's going to collapse, but it is part of the weight of the evidence that suggests that, or hints that maybe things aren't looking so good under the surface from a momentum standpoint, how in terms of how the stock market's doing internally. So think of it like, somebody who has a disease that they don't know about. They might not see it on the surface. They might look fine. If you just look at them and talk to them, you might not know that they have something wrong. But underneath the surface here, we've got a problem, at least for now. Now, whether that problem gets fixed over time, whether that be through just kind of working out and digesting the negative momentum divergence here, and then it heads higher, well, remains to be seen. But there's all kinds of catalysts. We've got a Fed rate meeting coming up next month. In December, we've got obviously a changing of the guard in the presidency now, which that's going to change some things, of course. So we just kind of need to be watching this. We don't need to look at a negative momentum divergence here and say, oh, let's sell everything and put all our money in money markets and CDs because the market's going to crash. This doesn't say the market's gonna do anything. All it's giving us is a hint that, hey, we're not seeing higher highs and momentum that are confirming these highs in price. So we want to pay a little closer attention and make sure that if we start to see some changing and rolling over in price and trend, that makes that rollover a little bit more valid due to the hint that we saw in advance. So I'm going to delete this here. So that's one way of looking at momentum. I thought about pulling up MACD, but I'm not going to do that. I think that's probably a little bit too much, and I want to make this podcast and screencast a little bit reasonably length. If you want to get in the weeds with me, every quarter I do an hour-long screencast, and I really go way into the weeds where I'm talking about momentum, trend, volume. I'm going over tons of breadth indicators, obviously looking at price, support and resistance levels. I look into, all kinds of different markets, not just the U.S. stock market, but international stocks. I look at bonds, commodities, currencies, digital assets like cryptocurrencies. So every quarter, we do that. The most recent one was the quarterly scouting report that I did in early October. The next one will be market outlook in January. So if you want to get even deeper in the weeds than we do in NERD-vember, then hold off or go back, to the most recent quarter in October to the scouting report, or check out the market outlook, which I'll be doing just after the first of the year. But let's move on here. So that's a little bit about momentum and how that works. Let's talk about volume. So I'm going to bounce over here I could do it in Optima, but this is just easier. It's got, red and blue for colors here down in the bottom. So in the bottom here, we're looking at the volume on a weekly basis. So this is a weekly chart, kind of slows things down a little bit, eliminates a little bit of the noise that happens throughout the week. And in the bottom, what we have is blue volume. That's the volume of that week if the market was up that week. Red volume is if the market was down that week. That's the volume that week. So it just shows you how much volume is being traded on a weekly basis. And if it's an up week, it's blue. And if it's a down week, it's red. So that's the first thing. Second thing that you see here is this line, this horizontal kind of bumpy line. That's the average volume. So it's the average daily or weekly volume in this case. And where it starts to get significant is when you see volume spike above that average weekly volume. So that's what we want to be paying attention to. So two things. One, we want to be paying attention to whether or not it's a good week and volume is high or low, and if it's a bad week and volume is high or low, and then second of all, if it's above average volume on good or bad weeks. So here we can see we've got the market in an uptrend, right? This is the S&P 500 iShares S&P 500 ETF, which is IVV. We've got a 40-week moving average here in the black. Got a 10-week moving average here. I believe that's red. Apologize for my color blindness. And as you can see, the most recently, it hasn't been anything really all that significant. We've got a couple down weeks here. Let's see, 3 weeks ago, we had a down week, but on relatively low volume, at least below average volume. Then we had an up week on below average volume, a down week again last week on below average volume. And so far this week's an up week, but also below average volume. So what this tells me right off the bat is that we've got an uptrend, obviously. That's without, unequivocally, this is an uptrend. But the second thing I'm seeing here is that the volume isn't telling us a whole lot, which means that, investors, traders, the smart money, they're just kind of waiting and seeing what happens here. And when I say that, what I mean is there could be a number of reasons why we're seeing below average volume. It could be that we're closing in on the holidays. It could be that they want to see what the Fed's going to do. Could be because there's a lot of Fed speak happening right now. Obviously, the changing of the guard with the presidency, which doesn't officially take place until January. So maybe people just are traders, investors. Maybe things are just muted right now because they're just kind of in a wait and see mentality. So that could be part of it. But anyway, when it's below average, it's not all that significant, but that's what we want to be looking for. So let's go through a few major market indices and some stocks and kind of see what things look like here. So here's the Koos. This is the NASDAQ 100. And you can see here again, kind of declining average volume here. So volume hasn't been, really big this last, several weeks, couple months really. So declining volume, but nothing again that really sticks out here other than the fact that I'm seeing more blue than red. And keep in mind the election was just a couple weeks ago at this juncture. So we were looking at a few weeks here in terms of volume that really matters in the new regime. Here's Morningstar's growth ETF. So the symbol is IM as in Mary, CG. And this is significant here. I'm looking at election week. We've got a big spike here of not only the price was up about 6.8% that week, but we've got a pretty big, above average volume day. So 158% of the average daily volume is what we saw that week on an up week. That's good. That's significant. That's good information. That's giving me another hint, or again, think of this as weight of the evidence. It's not like if this happens, we do that. And if that happens, we do this. It's a dimmer switch, not an on-off switch, which means with every indicator, with every piece of information we're looking at, every piece of the evidence that we're trying to create a big picture with, this is one of those pieces of evidence, and it's positive. So that's good, obviously, as far as for those of us who want the market to go up, right? This is iShares, another iShares Morningstar ETF. 3 weeks ago, we got a spike. The week before the election, it was, 250% of average volume that week, and a down week, whereas the election week was above average volume to the tune of, let's see here. No, it looks like about just 50%. So anyway, so that wasn't all that significant. NVIDIA, interestingly enough, the week isn't over yet. We've seen declining volume over time here this last few months, almost like people are getting less and less excited about NVIDIA. But this week so far, it looks like we're going to have volume being a little bit higher than the average. We've got about, I'm recording this Friday, November 22nd, and as you can see in the upper right-hand corner here, and it's looking like we've got about, 40 minutes left in the trading week, and this is probably going to end down on the week, potentially. Looks like just 0.05%, by the way, so it could end up for all we know. But bottom line is, we're seeing our first volume spike for the first time in a while. I'm going to go a little faster through some of these because I don't want to talk too much about each individual position, but this is Meta, in other words, Facebook. Not a whole lot of information here aside from 4 weeks ago. So before the election, we had, kind of a volume spike above average, and it was a down week. So that's good information, kind of a short-term downtrend here. If I look up at the chart, this is Broadcom. Let's see here. Not a whole lot of information here in volume, so negligible. Netflix, different story. Netflix has already hit all-time highs. Huge week this week, up almost 9%, and a volume spike. As you can see, we've got a blue volume bar here, and it's above average volume. And we also had 5 weeks ago, the same thing. but volume was 118% above average during that week. Intuitive Surgical, another stock, we had last week, this is a negative volume spike. So down week, as you can see up top here, but volume was high on a down week. That's not good. But at the same time, this is why if you remember from my last episode, it's why I always talk about how price and trend matters most. Or as my friend Brian Shannon always says, only price pays. You can have a million indicators. In fact, it's a pet peeve of mine when I see charts on Twitter where people put like 6 indicators under the chart and then they've got lines all over it and clouds and, Bollinger Bands. And there's so many things on the chart. It's too much. There's just, it's not that complicated. I think you need to have, 1 or 2 momentum indicators that you use. You need to pay attention to horizontal lines of support and resistance for polarity. I think you need to pay attention to trend, whatever your time frame happens to be. If you're a short-term trader, then you're looking at, anywhere between 1 and 3 weeks. If you're a swing trader, if you're looking at intermediate, we'll say short-term, you're looking at a month or 2. Intermediate term, you're looking at more like 6 to 9 months. That's me. That's what we do. We're kind of in the middle, intermediate term. If you're long-term, you're looking out 1, 2, 3 years. So anyway, when you look at this chart here for Intuitive Surgical, this is without a doubt an uptrend. In fact, not only is it trading very, very high above its 40-week moving average, which is the same as the 200-day moving average, but it's trading pretty solidly for the most part above its 10-week moving average. And really, really strong stocks or indices, really strong indices, ETFs, stocks, bonds, doesn't make a difference. Commodities have a tendency to trade and hold above their 10-week moving average. So I can't remember who it was that coined the phrase daylight, but the distance between the moving average and price is called daylight. And the more daylight you have, the stronger it is. It also means that the more daylight you have, especially if you get a big, huge spike in daylight, like way back here in March of 2024, so March of this year, when there gets to be a lot of daylight, you tend to see pullbacks. It doesn't mean the trend is over. It doesn't mean the stock's going to crash or anything like that. It just means that, it needs to breathe. That's how the market works. There's no such thing as a stock that just goes up straight in a straight diagonal smooth line. If it were only that easy. Here's Vertex Pharmaceuticals. Now we've got 2 weeks in a row of above average negative volume, meaning last week the stock's down almost 10%. This week it's down about 3%, and it cracked below its 40-week moving average, which it looks like it's probably going to close below that today. It's only about 1% below its 40-week moving average or 40-week trend. So that's not really, really significant. You can look back here to December of last year, and it was just above that moving average. Yeah. And then when we look into February and March, it was about 2.2% below it, 1.2 and 2.5% below it again, but it managed to recover and rebound. However, the last thing we'll talk about is relative strength, and there's several ways to measure relative strength. This is IBD's software Market Surge that I use, and their relative strength rating uses a few different metrics and kind of combines them together, compares all the stocks versus their peers versus the market. And what this is basically telling us here is the relative strength of Vertex Pharmaceuticals is 50, which means it's outperforming or has relative strength that is stronger than 50% of the stocks out there. So that's not really the best relative strength rating in the world. I think you want it to be above at least 60 in my book, but the higher the better, of course. So what we're seeing is a decline in relative strength. If I were to draw a line here, and I just drew a line at the lows, which, oops, sorry about that. Let's see, I'll clear this out. There we go. And if I draw a line at these lows, you can see straight across. That's not something I would normally do, but I just noticed it as I was looking at the chart here, that the relative strength characteristics of this stock keep hitting this 50 level or a similar level, and it's just bouncing off of it. But we'll see if that happens this time. When you see above average spikes like this, 2 weeks in a row, above average volume, and a couple, big down weeks, we're talking about 13% drop in the market, or I'm sorry, in this stock Vertex, it's starting to show up, throw clues up that maybe things aren't going so well. When you go back here to February and March, it was down 6%, then it was down 1.2%. But, and yes, you had a couple weeks of bad volume, but the drop in this stock and from a percentage standpoint during these 2 weeks back here, where it was not nearly as bad as this last 2 weeks. So I think that's going to be something we really have to pay attention to. So with this stock, which we own, full disclosure, in our clients' portfolios, I'll be looking at to see how this thing closes today. Then I'll look and see how it behaves on Monday after the open. And if after the European close, it's not really making much progress in terms of recapturing that 40-week moving average or 40-week trend, or if I'm not seeing more characteristics, relative strength characteristics that suggest that things are going to get better or recover here, then it's going to be time to sell the stock and move on to something else that has better promise for the future. So let's keep going. Costco. Not a whole lot of volume information here. It looks like 2 weeks ago we had a above average volume spike, not a huge spike, but above average volume 2 weeks ago on an up week. But this is, again, holding the 10-week moving average, holding the 40-week moving average. Since we talked about relative strength, it's got a relative strength rating of 84, which is very good. Cintas Corp, relative strength of 87, uptrend, clearly holding above its 10-week moving average. It's 40-week moving average. Just a little bit of a volume spike on good volume here. Election week 2 weeks ago. But that's all to say there. Here's Tesla. Tesla had a couple good blue weeks down here in volume, as you can see. Had one red week last week, so we had above average volume and a drop, but the drop was only 0.16%. So you get a big red volume day, but you see a very, very shallow drop that tends to make you think, okay, well, maybe even though it was a big volume day, if it was only a drop, would I say 0.16%? It's like, is that big of a deal, compared to the prior week? So, especially when you consider this week, even though we're not going to have above average volume, it doesn't look like for this week, you can see it's up almost 10% on the week. So that's obviously really good. Constellation Energy is somewhat volatile stock here, relatively new stock, IPO'd in March of 22, but it's holding its 40-week. It's got great relative strength here, using IBD's metrics. This week, we're not going to get a volume spike above average volume anyway. The last 2 weeks, well, actually the last 4 weeks were red, but this is an energy company, so depending on how things go with the new presidency, energy may or may not be a good sector to be invested in. But at least for now, this week the stock's up about 12%, and it's kind of going through its typical breathing, process that stocks do, investments do, I should say. But anyway, I think this looks pretty good. If I move on to Caterpillar, looks okay. No volume spikes down here. 2 weeks ago, election week, it did have a good week. Obviously a construction stock, but things are looking okay here. Relative strength rating of 82. This is Salesforce, and lots of blue here going back a couple months. Above average volume on good days. That's all good. Even though you had a drop here in price, you can see it went up about 10% almost 2 weeks ago. Then it was, even though it had gone up as much as $350 a share almost, it pulled back, but it still ended positive on the week. So it was still up 1%, even though it opened high on the week and then closed low. And then this week, what we have is the stock up about 5%. It doesn't look like above average volume, it's telling me just 4% below average volume. So we'll have to see how that works out, but good relative strength rating, obviously an uptrend, a little volatile, but anyway. IBM, also kind of a volatile stock, 82 relative strength rating, outperforming or higher relative strength than 82% of the stocks that are out there in the IDB universe. Not a whole lot of above average volume here. So not a ton of information down here, except, 4 weeks ago, 5 weeks ago, a couple red weeks, but it's kind of hard to look at anything right now, any further back than 3 to 4 weeks because of the election. What's going to matter now going forward is how are stocks going to perform as there is this changing of the guard in the presidency, and what kind of sectors are going to start outperforming, what sector is going to start underperforming, things like that. So in fact, I'll look at Amazon here real quick. Amazon, uptrend, kind of volatile here most recently. If I draw a line here in the sand, I'm just noticing, let's see here. Oops, my line. So here, draw a line straight across, get that as straight as possible. There we go. And what we're seeing is these previous highs from 2021. It cracked above it here. We have kind of a bull trap, heads back below it, tries to get above it, gets back below it. Now we've got a breakout to all-time highs. It's pulling back, which is completely normal. And it would make sense for it to pull back to this potential line in the sand, which was previously a ceiling of support and now could act as a resistance, a ceiling of resistance, and now could act potentially as a floor of support. So the saying in technical analysis goes that previous ceilings of resistance above our head once broken, then become potential floors of support going forward. So if this stock is going to stay bullish and continue heading higher, then what we want to see is we want to see that line in the sand hold. So if that makes sense, hopefully it does. American Express, not bad here, holding its 10-week moving average. Lots of daylight between its 40-week and the price. We got rising relative strength, 89 rating. We got a somewhat small 10% above average volume 2 weeks ago, the election week. But since then, just 2 weeks, one small red week, one small blue week, but up 5% on the week this week. So that looks all right. Just to have fun and move over to a couple other positions here, let's look at the sectors in the S&P 500. So here we look at materials, holding its trend, but relative strength isn't all that great. 54 relative strength rating and declining, holding its trend. But look at this big, huge volume spike here, 60% above average volume on election week. Since then, it's been pretty muted. We look at communications sector, volume, couple blue spikes above average here 3 weeks ago, or I should say 4 weeks ago technically, and 2 weeks ago. And then we've got price in an uptrend, good relative strength rating. That looks good. Energy is kind of flat. I mean, you can kind of draw a box right here. I'll do it. If we could draw a box around this kind of long-term consolidation, if you will. So here's the box, the man in the box, right? Alice in Chains. What am I talking about? Anyway, bad joke. So that's what we're looking at, is this kind of consolidation, sideways consolidation, even though technically it is kind of going up. This is a higher high here than this high. These are higher lows. The question is, what's energy going to look like with the new presidency? I mean, that's really what's going to matter here. Financials look amazing. Lots of blue volume weeks here, tons of them. Volume spike, the week of the election, volume spike above average. Last week, 15% above volume, average volume, 85% above average volume election week. This week looks a little bit more muted. But again, we're back to that same old, I don't know, the theme of wait and see. A lot of people are just kind of wait and see at this point. Industrials, couple blue spikes, red one here. So a little bit less exciting, I guess, if you want to use that word. A relative strength rating of 75, that's pretty good. And then technology here, kind of weaker than usual. Technology has been doing really, really well, obviously, this last year, 2 years, AI, things like that. Here's staples. Volume spike down here, blue volume day, election week, that looks good. But staples are the things we need. And the things we need are things like razors and food and things like that. And when we start to see staples outperforming the market and doing very well, that's not a good thing for the market. We want to see, I don't want to say we want to see staples doing poorly, because we never want to see anything doing poorly, but we want to see discretionaries doing well. And I'll jump down to discretionaries real quick here. When discretionaries are doing well, think about it. Staples are things we need, the staples in life. Discretionaries are the luxury goods. They're the things we want, all the fun stuff. And it's also the first stuff that we stop spending money on when markets aren't doing well, or when we think the market's going to do poorly, when we think there's going to be a recession or something along those lines. So what we see here instead is this rising trend in relative strength and discretionaries, luxury goods, fun stuff, going all the way back to August. And now we're looking at a relative strength rating of 80. We've got a volume spike during election week, about 24% above volume. It was up about 7.5%. And if I draw a line in the sand over here, we are now at all-time highs for the luxury goods discretionary sector. So that's good. That's good for the market. Real estate tends to be a defensive stock, or defensive sector, I'm sorry. And what we see here is declining relative strength, even though it's not terrible. And but it is trading in an uptrend technically. So kind of creating a little cup pattern here, saucer pattern potentially as things move forward. Utilities is also a defensive sector. It's been an interesting year. Utilities have actually done pretty well this year, which is interesting because usually they tend to be a little bit more muted in a really good year for the market. But instead, what we've seen is utilities doing really well, hitting all-time highs. In fact, this week, utilities are up 3%, relative strength rating of almost 80, and rising over time. If you go back to, looks like February here, pretty much long-term rising relative strength, so that's good. And then healthcare. Healthcare is also a relatively defensive sector, and this is bad. A relative strength rating of 31. It's the only sector I saw of all the major sectors in the S&P 500 that is actually in a downtrend. It's below the 40-week moving average. It's trading below a declining 10-week moving average with a weak relative strength rating. And while you did see today, this week, I'm sorry, a little bit above average volume on the positive side. Last week, above average volume to the downside, and the week before election week, above average volume to the upside. At the end of the day, what do we say? What's Brian Shannon say? He says only price pays, and the price is going down. This sector looks like it's rolling over. It's not. There's so many other better things we could be invested in here. And by the way, when it comes to investing, you never want to be that person that's looking for deals. Just because it's gone down doesn't mean it won't keep going down. So I wouldn't be looking for deals. It sounds counterintuitive, and I guess it is, but you want to be investing with strength. In other words, what we call it at our office is investing with the playoff teams. So that's what makes a whole lot more sense. If I look at some really bad industry groups here, auto, trucks, tires, not so great. This is ugly, right? Look at some other bad ones here. So alcoholic beverages, not doing so well. People are getting healthy maybe. I don't know. But non-alcoholic beverages, doing wonderfully. Relative strength rating isn't exactly the best in the world, but it's still an uptrend, right? If I keep going here, I'm looking at some bad stuff again. Building construction products, it's uptrend, not exciting, but what else? Another bad one maybe. Chemicals and plastics, yeah. Anyway, I can go on and on and on. There's 197 of these industry groups to analyze to death, but let me just show you one last thing here, and we'll close out for the day. But another way to look at, there's lots of ways to slice and dice relative strength. And if I look at, you can do like a 12-month rate of change. That's what I'm going to do here, called 12-month rock. So this is a 12-month rate of change of the major asset classes of the United States. So number one is S&P. Number two is small caps. Believe it or not, small caps are starting to catch up, which makes sense. Small companies benefit from lower interest rates. They also benefit from a government that is very business friendly, lower taxes. So that's why we're starting to see this big spike in small caps beating international stocks. U.S. dollar doing better. If we start seeing lower rates and we start seeing a tax environment that benefits small business, then these small company stocks are going to start doing better. But anyway, S&P number one, small company stocks number two, number three would be ex-US, so countries around the world, not including the U.S. Number four, would be just money markets, T-bills, short-term T-bills, so risk-free assets. Bonds were looking good there for a while. Now they're starting to roll over again. So we'll have to see what happens with the Fed this next month, tariffs, things like that. But we're going to have inflation, but we're going to have to see how interest rates and bonds do here because, we got to be careful what kind of bonds we're owning to make sure we're staying with strength. So commodities are in the basement. I won't talk a whole lot about that. So that's one way of looking at it. I'll show you one more way. And this is what's called a 26-week rate of change, which is basically 6 months. That's what 26 weeks is. If we look at bonds, you can see here the top decile would be convertible bonds and high yield. So in other words, more junk bonds, things like that. Number three, emerging markets bonds, so international bonds, staying above positive trend here. And then intermediate term corporate bonds, just below water. It looks like this week, maybe 2 weeks ago as well. I'm looking at a daily chart. Yeah, it's a weekly chart. So 4 weeks ago, it went below water, popped up, went down again, and now we're kind of looking iffy here, and it's looking iffy. Look at momentum down here. Momentum has been in a negative regime for a while now, and it's trying to get above the 70 on these spikes. As this thing rolls over, we see a 40-week moving average starting to move a little bit into the positive side here as well. But it would really help to see momentum start looking better as well. So if I go back up to convertible bonds, though, convertible bonds have already transitioned to a positive bullish regime when it comes to momentum, and then high yield also did the same right here. If you go back to what was this? Looks like October or September. Yep, September 27th, popped up above 70. So that's good too. So something to keep in mind. If I go back to, let's look at U.S. equities. So blockchain ETF looking good. See, regional banks are looking good. Telecoms looking good. Broker dealers. If I look at, let's look at just the S&P 500. So this is all, I think it's 503 stocks. I haven't checked lately to see how many exactly there are, but I think it's 503 or 502 stocks in the S&P 500. Doing a 26-week rate of change calculation here real quick. And you see number two on the list is Tesla. Lumen's up there as well. But you can see as you just go on the list, Coronado, Carnival Corp, that's Cruise Line, Carnival Cruise Lines, Norwegian Cruise Lines right behind them, Expedia, Royal Caribbean. These cruise lines that really, really struggled during COVID for obvious reasons have started to make a comeback. People are going back out, their vacation, they're having fun. And you can just kind of go through the list here and you can see, the top decile stops right here at Intuitive Surgical. Now we're in the second decile. And, these are all the playoff teams, and there's way more than enough to choose from here. But what you want to do is you want to stay invested with the playoff teams. And as the ranking changes below a certain line in the sand, once they fall below that line in the sand, it's time to eject them from the portfolio and buy whatever's at the top that we don't own. So that will conclude, I'm going to close this up, our presentation today, or our NERD-vember discussion about momentum, volume, and relative strength. So I hope you enjoyed it. If you have any other nerdy friends that like this stuff, feel free to share it with them. I would be happy to answer any questions you have. If you'd like a second opinion on your portfolio, second opinion on your retirement plan, better yet, if you don't have a retirement plan, we can talk about building one for you. So you definitely shouldn't go on the long trip of life and retirement income planning after retirement without a roadmap, just like you wouldn't travel across the country in a car without GPS or some sort of roadmap. So with that being said, thank you so much for watching, and we'll see you next time.
We hope you enjoyed today's episode. If you like a second opinion on your retirement plan or investment strategy, please head over to libertaswealth.com. This podcast is for informational purposes only and should not be considered as legal, financial, tax, or as the basis for investment decisions. Always consult a certified financial planner or a fee-only fiduciary advisor before acting on any ideas discussed.